I want to tell you about something that happened in the shadows of global finance over the past few months, something that didn't make headlines, something most people missed entirely, but it represents a seismic shift in how the world works. And once you understand what's actually happening, you'll realize we've crossed a threshold we can never uncross. Here's the situation. In the third quarter of 2024, Japan reduced its holdings of United States Treasury securities by $61.9 billion. Saudi Arabia quietly decreased its Treasury holdings by $5.7 billion. China has been systematically reducing its position for years. They now hold less than $800 billion, down from over $1.3 trillion a decade ago. Now, you might think, so what? Countries buy and sell bonds all the time. It's normal portfolio management, right? But here's what makes this different. What makes this the scenario Wall Street has been dreading in private meetings for years? These aren't just any buyers. These are the foundational buyers, the ones who absorbed trillions of dollars of American debt for decades, the ones who made the entire system possible, and they're not coming back. Let me explain why this matters, and I should warn you, what I'm about to walk you through will fundamentally change how you understand American power, global economics, and where we're heading. Because the United States Treasury isn't just losing customers, it's running out of options. And when the Treasury runs out of options, everything changes. Let's start with Japan, because their story reveals the mechanics of what's breaking. For 40 years, Japan was America's most reliable creditor. At their peak, they held $1.3 trillion in United States treasuries. They weren't doing this out of charity or friendship. They were doing it out of necessity, out of the mathematical logic of trade imbalances. Here's how it worked. Japanese companies, Toyota, Sony, Panasonic, would export cars and electronics to America. Americans would buy these products with dollars. Those companies would earn massive amounts of dollars, but they couldn't use dollars in Japan. Workers need to be paid in yen. Suppliers need yen, so those dollars had to be converted. Now, if every Japanese exporter tried to convert their dollars to yen simultaneously, what would happen? The yen would skyrocket in value. A strong yen makes Japanese exports expensive and uncompetitive. Japanese companies would lose market share. The economy would suffer. So the Bank of Japan would step in, buy those dollars, and invest them in the safest, most liquid market on earth. United States Treasury bonds. This was the grand bargain. America got cheap consumer goods and a willing buyer for its government debt. Japan got export-driven growth and employment. Everybody won. That system sustained the American standard of living for generations. But something fundamental changed. Japan's population is collapsing. They have more people over 65 than under 15. Their workforce is shrinking by 500,000 people per year. An aging society doesn't need to export and accumulate dollar reserves. It needs to import and spend down those reserves to support retirees, to pay for health care, to maintain living standards for a society where adult diapers now outsell baby diapers. Think about what that means. The largest foreign holder of United States debt is no longer accumulating. They're liquidating. Not because they want to hurt America, but because their own demographic reality gives them no choice. Every month, more Japanese retire. Every month, the country needs more resources from abroad. Every month, they sell more treasuries. Now let's talk about Saudi Arabia, because their situation reveals a different kind of pressure. For 50 years, since 1974, Saudi Arabia had an implicit deal with the United States. They would price oil in dollars. They would recycle their oil revenues into United States treasuries and American investments. In exchange, America would guarantee their security, provide weapons, and maintain the regional order. This was the petrodollar system. Every country that needed oil needed dollars to buy it. This created permanent global demand for dollars and for dollar assets, especially treasuries. It was one of the main pillars holding up American financial dominance. But look at what's happening now. Saudi Arabia is negotiating oil sales to China in yuan. They're discussing accepting rupees from India. They've joined BRICS, a bloc explicitly designed to reduce dependence on the dollar. Their treasury holdings have dropped from nearly $200 billion to less than $130 billion. Why? Because their calculation has changed. America's energy independence means they need Saudi oil less. America's pivot to renewable energy threatens oil's long-term value. Meanwhile, China is now Saudi Arabia's largest customer. The mathematical logic that sustained the petrodollar system for half a century is dissolving. And here's the crucial thing that keeps me awake at night. When Japan and Saudi Arabia were buying treasuries, they weren't making an investment decision. They were following structural economic necessity. Trade surpluses and oil revenues created dollars that had to go somewhere. Treasuries were the natural destination, but now those structural forces are reversing. Japan has demographic decline. Saudi Arabia has a changing energy landscape and new economic partners. These aren't temporary market fluctuations. These are permanent tectonic shifts. So if the traditional foreign buyers are stepping back, who's going to buy United States government debt? Because let me give you the numbers. The United States federal government will issue approximately $2.5 trillion in new debt this year. That's trillion with a T. Every single year, the Treasury needs to find buyers for trillions in new bonds, plus refinance trillions in maturing debt. The first option is domestic buyers, American pension funds, insurance companies, mutual funds, banks, and they are buying. They hold roughly $24 trillion in treasuries. But here's the problem. Domestic demand isn't infinite. At higher interest rates, many of these institutions would rather buy corporate bonds, stocks, or real estate. The yields are better. The returns are higher. To attract domestic buyers, the Treasury has to offer competitive rates, and rates have climbed dramatically. The 10-year Treasury yield has gone from under 1% in 2020 to over 4.5% recently. Every percentage point increase means hundreds of billions more in annual interest costs. Remember, the government now pays over $1 trillion per year just in interest. That number explodes with higher rates. The second option is the Federal Reserve, and they've done this before. During the financial crisis, during COVID, the Fed created trillions of dollars and bought treasuries. Quantitative easing, it worked in the short term. It prevented economic collapse, but it also triggered inflation. The consumer price increases of 2021 and 2022 were directly linked to all that money creation. Could the Fed do it again? Technically, yes. The Federal Reserve can create unlimited dollars, but politically and economically, it's treacherous territory. Inflation is the hidden tax that destroys savings, crushes fixed income retirees, and sparks social unrest. If the Fed returns to massive money printing while inflation is still above target, they risk losing credibility. And central bank credibility is everything. It's the belief that the currency will hold value. Once that belief cracks, you get hyperinflation, currency collapse, economic catastrophe. The third option, and this is what nobody wants to say out loud, is that the Treasury could fail to find enough buyers at acceptable rates. What happens then? Interest rates spike. The government faces a funding crisis. They're forced to slash spending dramatically or print money recklessly. Either path leads to severe economic pain. Now, before you think I'm being alarmist, let me tell you about what's already happening in the shadows. In September 2024, the Treasury held an auction for 20-year bonds. The bid-to-cover ratio, which measures demand, was the lowest in years. Dealers had to absorb a huge portion because other buyers weren't there. Similar weak auctions have occurred for 10-year and 30-year bonds. These are warning signs. The market is telling us that demand is softening. Foreign central banks are pulling back. Domestic buyers are cautious. The Treasury is increasingly reliant on a narrower base of buyers, and that makes the entire system fragile. Let me tell you a story that illustrates what this means in human terms. There's a woman I know, a retired nurse in Florida. She worked for 35 years, saved diligently, put money into her 401k every month. Her retirement fund is invested heavily in bond funds because she was told bonds are safe. Treasury bonds are the safest of all. But if the Treasury can't find buyers and interest rates spike, her bond fund loses value. If the Fed prints money to buy those bonds, inflation eats away her purchasing power. Either way, the savings she accumulated through decades of hard work are at risk, not because she made bad decisions, but because the system she trusted is running out of options, and she's not alone. Millions of Americans have pensions, retirement accounts, and insurance policies that depend on the stability of the Treasury market. This isn't some abstract Wall Street problem. This affects everyone. So what are the Treasury's actual options at this point? Let's be brutally honest about each one. Option one, convince foreign buyers to come back. How? You can't reverse Japan's demographic decline. You can't undo Saudi Arabia's economic diversification. You can't force China to trust American debt when the geopolitical relationship is increasingly adversarial. This option isn't really available. Option two, attract more domestic buyers with higher rates. But higher rates mean higher interest payments. The government already spends more on interest than on the military. Every rate increase makes the debt problem worse. It's a vicious cycle. And there's a limit to how much domestic buyers will absorb, especially when stocks and real estate offer better returns. Option three, the Fed returns to quantitative easing. This buys time, but risks inflation and currency devaluation. It's borrowing from the future. Eventually, the bill comes due. Option four, cut spending dramatically to reduce borrowing needs. This is theoretically possible, but politically nearly impossible. Social Security, Medicare, defense, interest payments. These are the big budget items. Cutting them enough to matter would require political consensus that doesn't exist. We can't even agree on a normal budget, let alone massive cuts. Option five, default or restructure. This is unthinkable for a country that borrows in its own currency. But history is full of unthinkable things that happened anyway. If confidence breaks, if buyers disappear, even the United States could face a choice between default and hyperinflation. Here's what Wall Street has feared in private for years. Not one dramatic crisis, but a slow squeeze. Foreign buyers gradually pulling back, auctions getting weaker, rates climbing, interest costs ballooning. The Fed trapped between inflation and funding the government. Each option worse than the last. No clear way out. And this brings us to what I think is the most important question. How did we get here? How did the United States, the richest country in human history, paint itself into this corner? The answer is we built an empire on borrowed money and assumed the borrowing could continue forever. We assumed Japan would always buy our bonds. We assumed Saudi Arabia would always recycle petrodollars. We assumed the world would always accept dollars and dollar debt without question. But empires don't last forever. Economic arrangements don't last forever. The world changes, and we didn't prepare for that change. We kept spending, kept borrowing, kept assuming someone else would finance it. Now the bill is coming due, and we're discovering that our options have narrowed to a point where every choice involves pain. The question isn't whether there will be adjustment. The question is whether that adjustment happens in a controlled, managed way or in a crisis that catches everyone by surprise. I don't have a crystal ball. I can't tell you exactly when or how this resolves, but I can tell you that the mathematics are unforgiving. When your largest creditors are liquidating, when your debt keeps growing, when your interest payments are exploding, when your options are narrowing, something has to give. The scenario Wall Street feared most isn't a sudden crash. It's this, a slow, grinding loss of options until one day we wake up and realize we're out of good choices. We're left with only bad ones and worse ones. Japan and Saudi Arabia aren't attacking America. They're responding to their own realities. But their actions have triggered something profound. They've exposed the fragility beneath American financial dominance. They've revealed that the system only worked as long as everyone played their part. And now the players are leaving the stage. The United States Treasury is running out of options. Not tomorrow, not next week, but the walls are closing in. And when you're out of options, you're no longer in control. You're reacting, you're improvising, you're hoping. And hope is not a strategy. We built a world where American debt was the foundation of global finance, where Treasury bonds were the ultimate safe asset, where the dollar's dominance seemed eternal. That world is ending, not with a bang, but with Japan selling bonds to fund retirees and Saudi Arabia accepting yuan for oil. The question now is what comes next, and whether we'll manage the transition with wisdom or stumble into it with chaos. Because ready or not, that transition has already begun.